We are drawn to the spectacle of success, the towering glass headquarters that scrapes the sky, the sprawling corporate campus that resembles a small city, the global brand name that seems to be etched into the very fabric of our culture. We see these things and we think, this is a winner, this is a fortress, this is a safe investment. We equate size with strength, complexity with sophistication, and expense with excellence. And in doing so, we make one of the most profound and costly mistakes in the world of finance. We become hypnotized by the symbols of success, while ignoring the engine of it. Warren Buffett, a man who has built one of the world's greatest fortunes from a small, unremarkable office in Omaha, Nebraska, has spent a lifetime teaching a different lesson. He taught us that the real magic, the real source of enduring wealth and market-beating returns, is rarely found in the gleaming monuments to corporate ego. It's found in the dirt. It's found in the boring, the mundane, the unglamorous. It's found in the small, scrappy operations that are pathologically obsessed with one thing: efficiency. It's the power of low-cost, decentralized operations that value every single dollar not as something to be spent, but as a soldier to be sent into battle for the shareholder. This principle is the antidote to the most common market mistake: investing in bloated, bureaucratic companies where layers of management, extravagant overhead, and corporate vanity act as a giant tax on profits, making it impossible to truly compete. By the end of our journey today, you will have undergone a financial transformation. You will learn to see the world through a new lens. You will find beauty in a sparse balance sheet. You will feel excitement when you see a low SG&A ratio, and you will understand that a lean, efficient business model is the most reliable predictor of higher profit margins and extraordinary shareholder returns. This isn't just a lesson in stock picking. It's a fundamental shift in how you analyze and understand the very nature of business success. Our first pillar in understanding this philosophy is to embrace what can only be described as a corporate cult, the cult of frugality. This is the recognition that obsessive cost control is not merely a defensive tactic to save money. It is the single most powerful, proactive, and sustainable competitive moat a company can build. It's a weapon that is perpetually sharp, always effective, and nearly impossible for a bloated competitor to replicate. To understand its power, we must travel back in time, not to a boardroom, but to the humble beginnings of a company that would fundamentally change an entire industry and become one of the crown jewels of Berkshire Hathaway. We must tell the story of Geico. The foundational anecdote of this pillar begins not with Warren Buffett, but with a man named Leo Goodwin Sr. in 1936. Goodwin was an accountant at USAA, an insurer that served military officers. He observed a simple but profound truth: certain groups of people are statistically much better risks than others. He theorized that federal, state, and municipal government employees were, like military officers, a self-selected group of stable, reliable, and responsible individuals. They were less likely to get into accidents, less likely to file fraudulent claims, and more likely to pay their premiums on time. But the revolutionary part of Goodwin's idea wasn't just who to target, but how. In the 1930s, the auto insurance industry was completely dependent on a vast, expensive network of agents. These agents were the gatekeepers, and they were paid handsome commissions for their work, a cost that was, of course, passed directly on to the customer. Goodwin saw this entire structure as waste. Pure, unadulterated, unnecessary cost. His idea was radical. What if you bypassed the agents entirely? What if you went directly to the consumer through the mail? By eliminating the agent's commission, which could be as high as 15 or 20% of the premium, he could offer his select group of low-risk government employees a dramatically lower price. The Government Employees Insurance Company, or Geico, was born. This wasn't just a new company. It was a new business model, built from the ground up on the bedrock of fanatical cost control. The company's headquarters wasn't a palace. It was a small office. There were no lavish expense accounts. Every penny was scrutinized. The savings were not funneled into executive bonuses. They were weaponized in the form of lower prices. This is where a young Warren Buffett enters the story. In 1951, as a student at Columbia Business School under the tutelage of the father of value investing, Benjamin Graham, Buffett discovered that Graham was the chairman of Geico. On a Saturday, driven by a surge of curiosity, Buffett took a train to Washington, D.C. and found the company's headquarters. The building was closed, but a custodian let him in. That custodian directed him to the only other person working that day, Lorimer Davy Davidson, who would later become CEO. For the next 4 hours, Davidson, a man who embodied the frugal, customer-obsessed culture of Geico, explained the entire business to the eager 20-year-old student. Davidson laid out the math. He explained how their lower expense ratio gave them an unbreachable competitive advantage. A typical insurer might have an expense ratio of 25%, meaning 25 cents of every premium dollar went to overhead and commissions. Geico, by operating direct, could run at an expense ratio closer to 10%. This 15-point advantage was gigantic. It meant they could charge significantly less and still be more profitable on an underwriting basis than their competitors. Buffett was electrified. He saw the beautiful, brutal, and simple logic of it. He went back to New York and put more than half of his personal net worth at the time, about $10,000, into Geico stock. He saw what others missed. They saw a small insurance company. He saw a perfectly designed, self-perpetuating money machine fueled by operational efficiency. The company had found a way to turn cost savings into a marketing machine. Lower prices attracted the best drivers, who then had fewer claims, which led to higher profits, which allowed for even lower prices. It was a virtuous cycle, a flywheel of frugality. Years later, after Geico ran into trouble in the 1970s due to a brief and disastrous deviation from its core principles, Buffett saw his opportunity not just to invest, but to own. Berkshire Hathaway began buying shares, and by 1996, they owned the entire company. The initial student's hunch, born from a 4-hour conversation on a Saturday, had blossomed into one of the most successful investments in history, all because he understood that the most durable competitive advantage wasn't a brand or a patent, but a culture of relentless, obsessive, soul-deep frugality. The story of Geico is a masterclass in business strategy, but it is also a profound lesson in behavioral science. The underlying psychological principle that makes this cult of frugality so powerful is a combination of two potent cognitive forces: commitment and consistency bias, and the customer's visceral pain of paying. Let's first examine commitment and consistency. Humans have a deep-seated psychological need to be consistent with things we have already said or done. Once we make a choice or take a stand, we encounter personal and interpersonal pressures to behave consistently with that commitment. When Leo Goodwin and later Davy Davidson built Geico's entire identity around being the low-cost provider, they weren't just making a business decision. They were forging a corporate identity. Every employee, from the CEO down to the mailroom clerk, understood this was the core mission. This commitment became a filter for every future decision. Should we open a network of fancy branch offices? No. That violates our commitment to low costs. Should we hire a huge sales force and pay them big commissions? No. That betrays our identity. This consistency creates a powerful internal culture. Frugality stops being a line item on a budget and becomes a source of pride. Employees start to see wasteful spending by competitors not with envy, but with contempt. They see it as sloppy, inefficient, and disrespectful to the customer. This cultural indoctrination is incredibly difficult for a competitor to replicate. A large, established insurer couldn't just decide to become low-cost. Their entire system, their legacy IT, their contracts with agents, their existing real estate footprint, and most importantly, their corporate culture, was built around a high-cost model. Trying to change would be like trying to turn an aircraft carrier on a dime. Geico's initial commitment, reinforced over decades, became a cultural moat that was just as powerful as its mathematical one. The second psychological force at play is on the customer's side: the pain of paying. This is a concept from behavioral economics that describes the negative emotions we feel when we part with our money. The pain is not always proportional to the amount. It's influenced by the method of payment, the timing, and the perceived fairness of the transaction. Insurance is a product that people are legally or practically required to buy, but nobody enjoys buying it. You are paying for a service you hope you never have to use. The pain of paying is therefore inherently high. Geico's entire model was a direct assault on this pain. By offering a premium that was 15, 20, or even 25% lower than the competition, they weren't just offering a better deal, they were offering a significantly less painful experience. This reduction in pain creates a level of customer loyalty that brand advertising alone can never achieve. When a customer knows they are getting the best possible price from a company that respects their wallet, they become evangelists. They tell their friends and family. This word-of-mouth marketing is not only the most effective form of advertising, but it's also free, further reinforcing the company's low-cost structure. Geico masterfully exploited the psychology of the customer. They understood that in a mandatory, unloved purchase category, the company that causes the least amount of financial pain wins. Their frugality wasn't just an internal metric, it was their primary customer-facing benefit, creating a bond of trust and relief that competitors, with their bloated cost structures, could never hope to match. Translating this powerful theory into a practical tool for business analysis and stock picking requires a structured mental model. We can call it the cost-first analysis blueprint. This is a step-by-step process any investor can use to identify companies with the same DNA as Geico, regardless of their industry. Step 1 is to deconstruct the industry's standard cost structure. Before you can appreciate a company's efficiency, you must understand what normal inefficiency looks like. For any industry you're studying, be it retail, software, manufacturing, or banking, map out the primary expenses. Where does the money go? In insurance, it's agent commissions, claims, and administrative overhead. In retail, it's cost of goods sold, rent for physical stores, and labor. In software, it's research and development, and sales and marketing. You must first understand the typical expense pie chart for the industry. Step 2 is to identify the single largest cost component that can be fundamentally challenged. This is the key insight. Leo Goodwin didn't try to shave 1% off of office supply costs. He targeted the single biggest, most vulnerable expense, the agent commission structure. He asked a heretical question: is this absolutely necessary? As an investor doing your own stock analysis, you must look for companies that have asked a similar heretical question. Did a retailer find a way to bypass expensive mall locations? Did a software company find a way to acquire customers without a massive direct sales force? Find the sacred cow of cost, and look for the company that has figured out how to get rid of it. Step 3 is to verify that the company has engineered a new business model that surgically removes or drastically reduces that core cost. This is about process innovation. Geico used the direct mail system. Dell Computers in its heyday used a direct-to-consumer online model to eliminate the costs and inventory risk of the retail channel. Southwest Airlines used a point-to-point flight model with a single aircraft type to slash the turnaround times and maintenance costs that plagued legacy carriers. The key is to see a deliberate, intelligent redesign of the business process, not just a temporary cost-cutting measure. Step 4, and this is crucial, is to see how the company uses the savings. The best companies, the true compounding machines, weaponize their cost savings by reinvesting them into a price advantage for the customer. They don't just let the savings fall to the bottom line as a one-time profit boost. They pass it on, lowering prices to attract more customers. This is what creates the flywheel. Costco does this with its membership model, using its scale to negotiate lower prices and passing almost all of that benefit to the customer, locking them into the ecosystem. This demonstrates a long-term mindset focused on market share and customer loyalty, a key ingredient for successful long-term investing. Finally, step 5 is to look for evidence of this feedback loop in action. Look for data showing that the lower prices are leading to faster customer growth than competitors. See if the increasing scale is leading to even better cost advantages, better negotiating power with suppliers, lower fixed costs per user, and so on. When you find a company that has successfully executed all 5 steps of this blueprint, you have likely found a business with a deep, durable competitive moat, a business that understands that frugality is the ultimate offensive strategy. To truly appreciate the genius of this model, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the approach taken by the majority of companies, the path that seems logical and ambitious, but so often leads to mediocrity or ruin. This is the philosophy of growth at any cost. This mindset is seductive, especially in booming markets. The focus shifts entirely from profitability and efficiency to top-line revenue growth and market buzz. The company's story becomes more important than its balance sheet. How does this manifest? It begins with a lavish spending culture. New funding or a rising stock price is seen as an excuse to dramatically increase spending. This includes hiring sprees, often for redundant or vaguely defined roles, to increase headcount, which is mistakenly used as a proxy for importance. It includes massive marketing budgets spent on glamorous but low return on investment campaigns, like Super Bowl ads or celebrity endorsements. It includes building a palatial headquarters and outfitting it with expensive furniture and unnecessary perks, all designed to create the image of success rather than the substance of it. The dot-com bubble of the late 1990s was the historical high watermark for this flawed philosophy. Companies like Pets.com, Webvan, and Cosmo.com raised hundreds of millions of dollars from investors captivated by the story of e-commerce revolutionizing everything. They spent this capital with breathtaking speed. Webvan built a network of incredibly sophisticated, automated warehouses that cost over $30 million each, long before they had the customer density to justify them. Their business model had negative unit economics. They famously lost money on every single grocery order they delivered. But the focus was on growth, get more customers, open in more cities, capture the market. The underlying fatal inefficiency of the business model was ignored. Pets.com spent millions on a clever sock puppet mascot and a Super Bowl ad, creating brand awareness but failing to solve the fundamental problem that shipping heavy bags of dog food was incredibly expensive and unprofitable. These companies weren't built on a foundation of frugal efficiency, they were built on a foundation of cheap capital and a good story. When the capital markets dried up, when investors started asking for profits instead of just growth, the entire edifice collapsed. The high burn rates, fueled by a bloated cost structure and a disregard for unit economics, became a death sentence. The path of the 99% chooses the appearance of success over the mechanics of it. It leases the fancy office before it has the profits to pay for it. It hires the expensive sales team before it has a product that can be sold profitably. It chases revenue without regard to the cost of acquiring that revenue. It's a company built on vanity and hope, and when faced with a competitor that has the discipline of Geico, a competitor with a lower cost structure, a better value proposition for the customer, and a culture of frugality, it simply cannot compete. It is a house of cards in a hurricane. The difference between these two philosophies is not just a matter of style or culture, it has a direct, quantifiable, and massive financial connection that is visible to anyone who knows where to look. For an insurance company like Geico, the ultimate proof is a metric called the combined ratio. This is the key performance indicator for any property and casualty insurer. It's calculated by adding together the company's incurred losses from claims and its operating expenses, and then dividing that sum by the earned premiums. A combined ratio of 105% means that for every dollar of premium the company took in, it paid out $1.05 in claims and expenses. It is losing money on its core business of underwriting insurance. A combined ratio of 95% means that for every dollar of premium, it paid out only 95 cents. It is making a 5-cent profit on its underwriting, even before it makes a single dollar from investing its float. This is the holy grail of the insurance business. For decades, Geico has consistently operated with a combined ratio significantly lower than the industry average. Its expense ratio, a component of the combined ratio, has been its killer advantage. While competitors were spending 25 or 30 cents of every premium dollar on commissions and overhead, Geico was spending 10 or 15 cents. This is not a small difference. For a company taking in tens of billions of dollars in premiums, that 10 to 15-point advantage translates into billions of dollars of additional underwriting profit each year. This profit is pure, tangible cash that flows directly to the bottom line. It increases the company's book value. It provides more capital to invest, creating a secondary stream of income. It gives the company the financial firepower to endure price wars and economic downturns that crush its less efficient rivals. This isn't abstract. It's the mathematical reality of operational efficiency. When you, as an investor, are performing your business analysis, and you see a company with a structural cost advantage that manifests in a superior key performance metric like the combined ratio, you are looking at the financial signature of a powerful competitive moat. You are seeing how the cult of frugality translates directly into superior shareholder returns, and the kind of long-term compounding that builds true and lasting wealth, the kind of wealth that leads to financial freedom. The second great pillar of the Scrappy operational philosophy is the principle of decentralized command. If frugality is about managing money, decentralization is about managing people. It is the profound understanding that the best decisions are not made in a distant, sterile corporate headquarters by executives reading spreadsheets. They are made by the people on the ground, the ones who are closest to the customer, closest to the inventory, and closest to the competition. It's about empowering local genius and unleashing the entrepreneurial spirit that lies dormant in so many large organizations. To truly grasp the explosive power of this idea, we must tell the story of one of the most remarkable entrepreneurs of the 20th century, a woman who Warren Buffett considered a managerial titan. We must tell the story of Rose Blumkin, the indomitable Mrs. B of the Nebraska Furniture Mart. The foundational anecdote of decentralized command begins in a dusty pawn shop basement in Omaha, Nebraska in 1937. Rose Blumkin, a Russian immigrant who had fled persecution and arrived in America unable to speak a word of English, started the Nebraska Furniture Mart with a $500 loan. Her business philosophy was so simple it was radical: sell cheap and tell the truth. She didn't believe in fancy displays or high-pressure salespeople. She believed in volume. She piled the furniture high, marked it with a razor-thin profit margin, and worked tirelessly, 7 days a week. She was the buyer, the seller, the bookkeeper, and the janitor. Her competitors, the established downtown furniture stores, were aghast. They pressured the major furniture manufacturers to boycott her, refusing to sell her their products. So Mrs. B would travel to other cities, buying from retailers there and shipping the goods back to Omaha to sell at a lower price than the local stores could manage. She built her business through sheer force of will, an obsession with low costs, and an unwavering commitment to giving the customer the best possible deal. By the early 1980s, her small basement operation had grown into the single largest home furnishing store in the United States, with over $60 million in annual sales and pre-tax profits that were the envy of the entire industry. This is when she came to the attention of Warren Buffett. In 1983, Buffett approached the then 89-year-old Mrs. B to buy her company. The negotiation was legendary in its simplicity. There were no teams of investment bankers, no legions of lawyers performing months of due diligence. Buffett asked her how much she wanted. She gave him a number. He said, "Okay." The entire deal, for a $60 million business, was sealed with a 2-page contract and a handshake. But the most important part of the deal wasn't the price. It was the promise. Buffett's core insight was that the magic of the Nebraska Furniture Mart wasn't its inventory or its real estate. It was Mrs. B and her family. Their obsessive, entrepreneurial drive was the company's true asset. So Buffett did something almost unheard of in the world of private equity and corporate acquisitions. He left them in complete and total control. He didn't send in a team of synergy experts from Berkshire Hathaway. He didn't impose a new reporting structure or a corporate budget. He gave them capital when they needed it, and otherwise he got out of the way. He decentralized command. The power of this decision was proven a few years later. At the age of 95, after a dispute with her grandsons over her management style, Mrs. B quit in a huff. She didn't retire. She crossed the street, bought a building, and opened a rival store called Mrs. B's Clearance and Factory Outlet, with the explicit goal of competing with the very business she had just sold to Buffett. And she started winning. She was pulling customers and revenue away from the much larger Nebraska Furniture Mart. Buffett, recognizing the absurdity of competing with a 95-year-old dynamo he had already paid for, went back to her and, with a laugh, bought her new company as well, agreeing to her one condition: that she could continue to work there. She worked until she was 103. This story is the ultimate testament to Buffett's belief in decentralization. He knew that you cannot replicate the passion, the local knowledge, and the speed of an owner-operator from a corporate office. The best approach for effective wealth management at the corporate level is to buy brilliant businesses run by brilliant managers and then let them do what they do best. The story of Mrs. B provides a dramatic illustration of a deep psychological principle: the power of the endowment effect and ownership bias. These cognitive biases describe our tendency to value something more highly simply because we own it. A simple coffee mug can feel more valuable to you once it's yours. This isn't just about monetary value. It's about psychological ownership. When you give managers true autonomy, when you decentralize command, you are giving them psychological ownership of their business unit. It ceases to be just a job and becomes their business. This triggers a powerful shift in mindset. They start to think like Mrs. B. Every dollar of expense feels like it's coming out of their own pocket. Every customer complaint feels like a personal failure. Every new sale feels like a personal victory. This sense of ownership is the most powerful motivator in business, far more effective than any complex bonus structure or top-down mandate devised by a consultant. This psychological ownership directly combats one of the most persistent problems in large corporations: the agency problem. The agency problem describes the inherent conflict of interest between the managers of a company, the agents, and the shareholders, the principals. Managers, if not properly incentivized, may act in their own self-interest rather than in the best long-term interest of the owners. They might pursue wasteful pet projects to build their resume, avoid making difficult but necessary decisions that could jeopardize their annual bonus, or focus on short-term quarterly earnings at the expense of long-term investments. In a decentralized system, where the manager's compensation and reputation are directly tied to the long-term success of their specific autonomous unit, the agency problem shrinks dramatically. The manager of a subsidiary of Berkshire Hathaway, for example, is not thinking about pleasing a committee at headquarters. They are thinking about maximizing the cash flow and competitive position of their business over the next decade. They are behaving like an owner, not a hired hand. This is the psychological genius of Buffett's model. He buys businesses with fantastic managers and then fuels their sense of ownership by giving them freedom. He turns agents into principals. This creates a federation of highly motivated entrepreneurs, all operating under one corporate umbrella, a structure that is far more adaptive, innovative, and profitable than a rigid top-down command and control system. To apply this principle to your own stock picking and business analysis, you need a mental model, a practical checklist for identifying companies that practice genuine decentralization. We'll call this the owner-operator litmus test. It consists of 4 key areas of investigation. First, investigate the management structure. Read the company's annual report and investor presentations. Is the company organized as a collection of autonomous business units, each with its own president or CEO? Or is it a functional structure where all decisions for marketing, finance, and operations flow up to a single C-suite at headquarters? Look for language that emphasizes the independence of divisional leaders. Companies like Berkshire Hathaway or Danaher are classic examples of a decentralized model, explicitly celebrating the autonomy of their operating companies. Second, you must analyze the incentive structure. This can be more difficult to find, but it's critically important. How are divisional managers compensated? Is their bonus tied primarily to the performance of their specific unit, including its profitability and return on capital? Or is it tied to the overall performance of the parent company's stock, which they have little direct control over? The best systems give managers skin in the game for their own domain. They are rewarded for running their business well, not for the whims of the broader stock market. Third, read the shareholder letters and listen to the quarterly conference calls. This is a qualitative but highly revealing step. Pay close attention to how the CEO speaks. Does the CEO constantly talk about corporate initiatives, centralized platforms, and synergies that are being imposed from the top down? Or do they spend their time highlighting the achievements of their individual business leaders, calling them out by name, and celebrating their successes? A CEO who acts more like a proud coach of an all-star team is more likely to be running a decentralized organization than one who acts like a general commanding an army. Warren Buffett's letters are a masterclass in this. He spends the majority of his time praising the managers of Berkshire's subsidiaries. Fourth and finally, look for evidence of internal entrepreneurs. Search for stories in the company's history or news reports about managers within a division who have launched a new product line, entered a new geographic market, or radically improved their operations with minimal oversight or funding from the corporate parent. This is the ultimate sign of a culture that empowers its people. When you find a company that passes this four-part litmus test, you've found an organization that has likely solved the agency problem and has unlocked the powerful psychological forces of ownership, creating a superior environment for long-term investing and wealth creation. To fully grasp the wisdom of decentralization, we must examine its antithesis, the path of the 99%, which can be described as the micromanaging monolith. This is the default structure for most large corporations, and it is a powerful engine for destroying value and demoralizing talent. The monolith is characterized by a deep-seated belief that all wisdom resides at the top, in the corporate center. It operates on a foundation of distrust, assuming that managers in the field cannot be relied upon to make important decisions. The result is a sprawling bureaucracy. Endless layers of middle management are created, not to support the front lines, but to monitor them. Every significant decision, a new hire, a marketing campaign, a capital expenditure, must travel up a long chain of command for approval, often getting diluted or distorted at each step. By the time the request reaches the executive suite, the context is lost, and the decision is made based on an incomplete or outdated picture. This structure is disastrous for several reasons. First, it is incredibly slow. In a fast-moving market, the company that can react quickest wins. The micromanaging monolith is perpetually stuck in meetings and approval cycles, unable to respond to competitive threats or customer needs in a timely manner. Second, it stifles innovation. An employee on the front lines might have a brilliant idea, but the prospect of writing a 30-page proposal and fighting it through 6 layers of management is so daunting that they simply give up. Creativity and initiative are punished, while conformity and following procedure are rewarded. Third, and perhaps most importantly, it drives away the best talent. A players, the true owner-operator types like Mrs. B, will not tolerate being micromanaged. They will leave to join a more nimble competitor or to start their own company. The monolith is left with B and C players, the people who are content to simply follow orders and collect a paycheck. This leads to a slow, creeping mediocrity that infects the entire organization. This is often seen in the aftermath of large corporate mergers. The acquiring company promises massive synergies, but then imposes its own rigid, centralized systems on the acquired business, destroying the very entrepreneurial culture that made the company successful in the first place. The result is not synergy, it's a corporate lobotomy. The financial connection between decentralization and superior shareholder returns is profound and can be measured through a key metric, return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital, both debt and equity, to generate profits. It is calculated as net operating profit after tax divided by invested capital. A high and sustainable ROIC is one of the clearest signs of a well-managed, high-quality business. Decentralized companies often exhibit consistently higher ROIC, and the reason is simple. They make better capital allocation decisions. In a centralized monolith, Capital allocation is a political process. The managers who are best at building PowerPoint decks and navigating corporate politics often get the most capital for their pet projects, regardless of the potential returns. In a decentralized company, capital allocation is an economic process. Capital naturally flows to the managers who have a proven track record of generating the highest returns. The CEO's job in this model is not to dream up grand strategies, but to act as a smart banker, taking the excess cash generated by the successful subsidiaries and reallocating it to the managers who have the best opportunities for profitable growth. This creates a virtuous cycle of internal competition and meritocracy. The managers who use capital wisely are given more of it. The ones who don't, aren't. This ruthless focus on returns at the individual business unit level prevents the kind of wasteful corporate-level spending that plagues so many large companies. By empowering the people closest to the information to make investment decisions, the company as a whole generates a much higher return on its capital. This superior ROIC directly translates into faster growth and intrinsic value, which, over the long term, is the primary driver of capital gains and shareholder returns. When your business analysis uncovers a company with a decentralized structure and a consistently high ROIC, you have found a business that not only has a great culture, but also has a brutally effective financial engine for creating shareholder wealth. Now we must turn our attention to the great temptation, the siren song that lures so many investors onto the rocks of financial ruin. Our third pillar is an examination of a widespread corporate pathology, the Oedipus complex. This is the deep-seated, ego-driven need for companies and their leaders to build physical monuments to their success. It's the belief that a grand, impressive headquarters is a sign of a grand, impressive company. Warren Buffett knows this is one of the most dangerous red flags in business. He understands that every dollar spent on excessive corporate luxury is a dollar stolen directly from the pockets of the shareholders. Corporate vanity is the enemy of shareholder value, and recognizing it is a crucial skill for any serious investor focused on beating the market. The foundational anecdote for this pillar is a tale of two headquarters. First, consider the corporate office of Berkshire Hathaway, one of the largest and most successful companies in human history. It is located on the 14th floor of Kiewit Plaza, an unassuming office building in Omaha, Nebraska. The office itself occupies about 25,000 square feet. The total headquarters staff numbers around 24 people. There is no Berkshire Hathaway Tower piercing the clouds. There are no soaring atriums, no marble floors, no subsidized gourmet cafeterias. Buffett himself has worked in the same modest office for over half a century. The culture is one of purpose and frugality. The headquarters exists for one reason: to support the operating businesses and to allocate capital. It is a tool, not a trophy. Now contrast this Spartan scene with the world of R.J.R. Nabisco in the 1980s, a story immortalized in the book Barbarians at the Gate. The CEO at the time, F. Ross Johnson, presided over a culture of almost unimaginable corporate excess. The company's headquarters in Atlanta was a palace. More famously, the company operated its own private air force, dubbed the RJR Air Force, a fleet of nearly a dozen corporate jets. These planes were used to fly executives, their families, and even their dogs around the world. There were stories of jets being dispatched to carry a single executive to a golf game. The company built a massive, opulent hangar complex complete with luxurious lounges, sleeping quarters, and a staff of pilots and flight attendants who were on call 24/7. This staggering expense had absolutely nothing to do with selling more cookies or cigarettes. It was purely about executive ego and comfort. It was a manifestation of the Oedipus complex on an epic scale. The management team had come to see the shareholders, money as their own personal piggy bank. This culture of bloat and disregard for costs was a symptom of a deeper rot within the company. It signaled a management team that was more focused on its own perks than on creating value. It's no surprise that this culture of excess ultimately led to a leveraged buyout that saddled the company with crippling debt and highlighted the massive inefficiency that had been allowed to fester. The contrast could not be more stark. Buffett's humble office is a symbol of a culture laser-focused on shareholder returns. The RJR hangar was a symbol of a culture laser-focused on executive privilege. The edifice complex is a flashing red light, warning investors that management's priorities are dangerously out of alignment with their own. The psychological principle driving the edifice complex is a powerful cocktail of social proof and what we can call the peacock effect. Social proof is our tendency to look to others to determine how we should behave in a given situation. In the corporate world, CEOs look at their peers. When a rival company builds a stunning new headquarters designed by a world-famous architect, other CEOs feel an immense pressure to follow suit. The new building becomes the new standard, the new symbol of being in the big leagues. To not build one feels like admitting you are second-rate. It becomes a corporate keeping up with the Joneses, an arms race of architectural vanity. This is not driven by a rational calculation of return on investment. It's driven by the fear of being perceived as less successful than the competition. The peacock effect is related to this, but it's more about internal ego. A male peacock displays its extravagant tail feathers not because they help it fly better or find food, but to signal its fitness and status to potential mates. Similarly, a grandiose headquarters, a fleet of corporate jets, or a sponsorship of a prestigious golf tournament are the corporate equivalent of peacock feathers. They are costly signals designed to broadcast success, power, and prestige. The CEO gets a thrill from seeing their company's name on a skyscraper. They enjoy the ego boost that comes from showing off their corporate palace to visitors and the financial press. This is management using shareholder assets to enhance their own social standing and gratify their own ego. The problem is that, unlike the peacock's tail, which is at least linked to reproductive success, the corporate headquarters often becomes a financial albatross. It's a massive, fixed, illiquid asset that consumes capital for its construction and ongoing maintenance. Capital that could have been used to pay down debt, buy back stock, or invest in more productive, revenue-generating projects. The edifice complex is a triumph of psychology over economics, of ego over returns. To protect your portfolio from this value-destroying pathology, you need an applied mental model. Let's call it the headquarters-to-profit ratio scan. This is a quick, qualitative and quantitative checklist to spot the warning signs of corporate vanity. The first step is purely visual. Find pictures and descriptions of the company's headquarters. A simple online search will often suffice. Ask yourself, does this look like a functional, cost-effective workspace designed to facilitate productivity? Or does it look like a monument, a corporate museum designed to impress? Look for excessive architectural flourishes, vast empty atriums, and reports of extravagant materials. Is it a tool for the business or a pedestal for the CEO's ego? The second step is to scrutinize the company's annual report and proxy statement for mentions of other high-status, non-essential spending. Look for disclosures about corporate jets. While a single plane might be justified for a massive global company, a fleet of them is almost always a sign of the RJR Nabisco disease. Look for information on executive retreats at lavish resorts or excessive sponsorship deals that seem more about entertaining clients and executives than generating a clear return. Third, dig into the executive compensation section of the proxy statement. This is where the alignment of interests, or lack thereof, is laid bare. Are the CEO's pay and bonus tied to clear, difficult-to-achieve performance metrics like return on invested capital or growth in free cash flow per share? Or is the compensation high and rising regardless of the company's actual performance? A board of directors that is willing to approve a lavish headquarters is often the same board that is willing to approve excessive pay packages that are not tied to performance. Finally, and most quantitatively, compare the growth in the company's SG&A expenses, that's selling, general, and administrative costs, to the growth in its revenue over the past 5 to 10 years. SG&A is where the costs of the fancy headquarters, the corporate jets, and the bloated administrative staff live on the income statement. If SG&A is consistently growing faster than revenue, it is a massive red flag. It indicates that the company is becoming less efficient as it grows. The corporate bureaucracy is expanding faster than the actual business, a sure sign of bloat and a potential precursor to declining profit margins. The antithesis to the Oedipus complex is not just about being cheap. It's about a cultural mindset we can call the lean ethos. This is the philosophy practiced by companies that take genuine pride in their operational simplicity and resourcefulness. It's a belief that every dollar saved on unnecessary overhead is a dollar that can be used to strengthen the business or reward the shareholders. The early days of Amazon are a legendary example of this. Jeff Bezos famously ran his fledgling company from a garage, and his first desks were made from inexpensive wooden doors purchased at Home Depot. This wasn't because he couldn't afford a real desk. It was a deliberate cultural signal. He was telling every employee that they were there to serve customers and build a great company, not to surround themselves with the trappings of success. He wanted a culture of invention and resourcefulness, and a fancy office was antithetical to that mission. This ethos can be maintained even as a company grows to enormous size. Costco's corporate headquarters in Issaquah, Washington, is famously Spartan. It's located in what is essentially one of their warehouses. The CEO's office is not a palatial suite. This sends a powerful message throughout the organization. We are in the business of delivering value to our members, and we do that by keeping our costs as low as possible, everywhere. The lean ethos sees a fancy headquarters not as a badge of honor, but as a sign of waste and a betrayal of the customer. For entrepreneurs building their own businesses, this is a critical lesson. A focus on maintaining a lean and frugal culture from day one is not a sign of weakness. It's a profound source of strength and resilience. It allows you to offer better prices, to withstand economic downturns, and to build a business with a solid, profitable foundation. The direct financial connection between the Oedipus complex and poor shareholder returns is immediate and painfully clear. It lives on a single line item on the income statement: selling, general, and administrative expenses, or SG&A. This line item is the catch-all for all the non-production costs of running a business: executive salaries, corporate headquarters rent and maintenance, marketing, administrative staff, and yes, the fuel for the corporate jet. Let's quantify the impact. Imagine two competing companies, Company A and Company B, both in the same industry and both with $1 billion in annual revenue. Company A has embraced the lean ethos. They have a modest headquarters, a small corporate staff, and a culture of frugality. Their SG&A runs at 10% of their revenue, or $100 million. Company B, on the other hand, has a severe case of the Oedipus complex. They have a stunning glass tower headquarters, a large administrative staff, and a taste for lavish events. Their SG&A runs at 15% of revenue, or $150 million. That 5 percentage point difference doesn't seem huge, but it amounts to $50 million of extra, unnecessary cost every single year. That $50 million comes directly out of pre-tax profits. It's $50 million that cannot be used to fund research and development, to pay down debt, to buy back shares, or to pay dividends to shareholders. Over a decade, that adds up to $500 million of shareholder value incinerated on the altar of corporate ego. This difference flows directly through the financial statements, resulting in a significantly lower operating profit margin for Company B. A lower operating margin means less net income, which means a lower stock price, all else being equal. When you are conducting your stock analysis, comparing the SG&A to revenue ratio of a company to its closest competitors is one of the most powerful and simple checks you can perform. A consistently lower ratio is often the clearest financial signature of a management team that respects shareholder capital and is focused on efficiency, a hallmark of superior portfolio construction. This brings us to our fourth pillar, where we move from qualitative observations to the hard science of financial investigation. We must learn how to measure what matters. It's not enough to appreciate the philosophy of a lean operation. You have to be able to prove its existence and quantify its impact using the company's financial statements. This is about developing the skill to perform a financial X-ray, to look past the surface-level story of a company and see the true health of its operational skeleton. Mastering these metrics is what separates a novice investor from a professional analyst and is a cornerstone of any effective value investing strategy. Our foundational anecdote for this pillar involves one of Buffett's most famous and successful investments, the Washington Post. In the early 1970s, the newspaper industry was in a state of panic. The rise of television news was seen as a mortal threat. Newspaper stocks were trading at rock-bottom valuations, and the consensus on Wall Street was that they were a dying business. But Buffett, doing his deep-dive business analysis, saw something entirely different. He wasn't looking at the gloomy headlines. He was looking at the financial statements and the underlying business model. He saw that a dominant city newspaper like the Washington Post was not just a newspaper, it was an economic franchise. It had a powerful local monopoly on advertising. If a local department store wanted to reach the majority of households in Washington, D.C., they had to advertise in the Post. This gave the company incredible pricing power. More importantly, Buffett saw a business with a wonderfully efficient operating model. The cost of producing the first copy of the newspaper, paying the reporters, editors, and printing press staff, was very high. But the marginal cost of producing each additional copy was incredibly low, close to the cost of paper and ink. As circulation grew, the revenue grew dramatically, while the costs grew only slightly. This created what economists call, quote, operating leverage. It was a business with inherently high and scalable profit margins. While other investors were panicking about the future of news, Buffett was calmly analyzing the financial statements and seeing a cash-generating machine that was being offered at a ridiculously cheap price. He saw that its operating margins were durable, its capital requirements were low, and its competitive position was secure. In 1973, Berkshire Hathaway invested about $11 million into the company. Over the next 3 decades, that single investment grew to be worth over $1 billion. This legendary success was not the result of a hot tip or a lucky guess. It was the result of a disciplined, quantitative analysis of the company's operational efficiency, a focus on measuring what truly mattered while ignoring the market's irrational fears. The psychological principle that this quantitative approach helps to overcome is the focusing illusion. The focusing illusion is a cognitive bias where we place too much importance on one aspect of an event or a decision, causing us to misjudge the broader reality. In investing, the focusing illusion is rampant. Investors will fixate on a single, easily digestible piece of information. They might focus on a company's exciting new product, its charismatic CEO, or its incredible top-line revenue growth. For example, a biotech company might announce a promising new drug, and investors will pour money into the stock, focusing entirely on the potential market for that one drug. They completely ignore the company's massive cash burn rate, its history of failed clinical trials, and the enormous marketing costs required to launch a new drug. They are focusing on the exciting story, not the boring but crucial financial reality. Similarly, a software company might be reporting 50% year-over-year revenue growth. Investors, hypnotized by this single impressive number, will bid the stock up to astronomical valuations. They fail to look deeper at the income statement, where they might discover that the company is spending $2 on sales and marketing to acquire every $1 of new revenue, resulting in massive losses and a fundamentally broken business model. Measuring what matters, conducting a full financial X-ray, is the antidote to the focusing illusion. It forces you to look at the whole picture. It forces you to ask the difficult questions. Is this growth profitable? Is the company generating cash? How efficiently is management using my capital? It replaces a simple, emotionally appealing story with a multifaceted, rational, and far more accurate diagnosis of the business's health. This disciplined, quantitative approach is essential for achieving financial freedom through investing, as it protects you from the hype and narrative traps that ensnare the majority of market participants. To execute this financial X-ray, we need an applied mental model, a dashboard of key efficiency metrics that you can apply to any company you analyze. This is your efficiency dashboard for stock picking. There are 5 key gauges you need to check. First is the operating margin. This is calculated as operating income divided by revenue. It tells you how much profit a company makes from its core business operations before accounting for interest and taxes. The key here is not just the absolute number, but the comparison. You must compare the target company's operating margin to its closest competitors over a 5 to 10-year period. A company that consistently maintains a higher operating margin than its peers has a clear competitive advantage, likely rooted in a lower cost structure or superior pricing power. Second is SG&A as a percentage of revenue. As we discussed earlier, this is your primary gauge for corporate bloat. Track this ratio over time. A stable or, even better, a decreasing ratio as the company grows is a powerful sign of operational efficiency and scaling advantages. An increasing ratio is a major red flag. Third is the asset turnover ratio, calculated as revenue divided by total assets. This metric tells you how efficiently a company is using its asset base, its factories, equipment, and inventory to generate sales. A higher number is better. A lean company sweats its assets, wringing every possible dollar of sales out of them. A bloated company has lazy assets sitting around, not generating returns. The fourth gauge, particularly for retail or manufacturing businesses, is inventory turnover. This is calculated as the cost of goods sold divided by the average inventory. It measures how many times a company sells and replaces its inventory over a given period. A high inventory turnover is a sign of extreme efficiency. It means the company's products are selling quickly, and very little capital is being tied up in slow-moving goods sitting in a warehouse. This frees up cash for more productive uses. The fifth and final gauge on our dashboard represents the ultimate measures of profitability: return on equity, ROE, and return on invested capital, ROIC. These ratios measure how effectively management is using the shareholders' money, ROE, and all the company's capital, ROIC, to generate profits. Consistently high numbers, generally above 15%, are the hallmark of an excellent, efficiently run business. A company that can consistently generate high returns on its capital without employing a lot of debt is a true compounding machine and a prime candidate for long-term investing. By systematically checking these 5 gauges, you move beyond storytelling and into the realm of professional business analysis. The antithesis of this disciplined, quantitative approach is what we can call the story stock trap. This is perhaps the single most common and destructive path for amateur investors. It's the process of falling in love with a company's narrative rather than its numbers. The story can be incredibly compelling. It might be a visionary CEO who wants to change the world. It might be a disruptive new technology that promises to create a new industry overnight. It might be a brand that is perceived as cool and futuristic. The investor, captivated by this story, buys the stock without ever doing the hard work of reading the financial statements. They become emotionally invested in the narrative's success. This is dangerous because great stories and great businesses are not always the same thing. Theranos had a great story and a visionary CEO, but it was a complete fraud. Many of the clean energy companies of the 2000s had a wonderful story about saving the planet, but they had terrible business models that burned through billions in investor capital with no hope of profitability. The story stock investor ignores all the warning signs from the efficiency dashboard. They'll see declining margins and say, they're just investing for growth. They'll see a ballooning SG&A and say, they're just building out their team. They'll see a negative ROIC and say, you just have to believe in the long-term vision. They have abandoned the language of business, the language of profits, margins, and returns, and have embraced the language of faith and hope. Value investing, the philosophy of Buffett, is the polar opposite. It insists on verifying the story with numbers. It demands evidence of profitability and efficiency. It seeks to buy wonderful businesses at fair prices, and a wonderful business is, by definition, one that scores highly on the key metrics of our efficiency dashboard. The direct financial connection between high-efficiency metrics and shareholder returns lies in the mathematical magic of compounding. Let's run a simple but powerful side-by-side comparison to illustrate this. Consider again Company A, the lean operator, and Company B, the inefficient one. Both have $1 billion in sales. Company A, thanks to its operational efficiency, has a 20% operating margin, generating $200 million in operating profit. Company B, with its bloated cost structure, has only a 10% operating margin, generating $100 million in operating profit. That's a $100 million difference in cash-generating power every single year from the same amount of revenue. Now, let's project this forward. Assume both companies can reinvest this operating profit back into their business at a respectable 15% rate of return. At the end of year one, Company A has an extra $100 million to reinvest. At a 15% return, that generates an additional $15 million in profit the following year. Company B has no such surplus. Over 10 years, the difference becomes staggering. The massive surplus cash flow generated by Company A allows it to invest more in R&D, make strategic acquisitions, pay down debt faster, or buy back its own shares, all actions that increase the intrinsic value of the business. Company B is stuck on a treadmill, struggling just to maintain its position. The initial 10% difference in operating margin doesn't just lead to a 10% difference in value, it creates a massive, ever-widening gap. The stock price of Company A will compound at a much higher rate than Company B's. This is the core engine of wealth management and portfolio construction. Identifying and investing in companies with high and sustainable profit margins, a direct result of their operational efficiency, is the most reliable way to harness the power of compounding and build significant wealth over the long term. This brings us to our fifth and final pillar, where we turn the lens of our analysis away from the companies we invest in and onto ourselves. We must now focus on building the lean portfolio. The principles of frugality, decentralization, and efficiency are not just for analyzing businesses. They are a powerful philosophy for managing your own capital. Applying the Scrappy operational mindset to your own wealth management and asset allocation strategy is the final, crucial step in translating this knowledge into tangible financial freedom. The costly market mistake this prevents is falling for the bloated, high-cost, and inefficient model of the traditional financial industry, which is often designed to enrich the provider, not the client. The foundational anecdote for this pillar comes from Buffett's own early career, specifically from his partnership letters written between 1957 and 1969. Before Berkshire Hathaway, Buffett ran a small investment partnership for a group of friends and family in Omaha. His operational setup was the epitome of the lean philosophy. He worked out of a small office in his home. He had no staff of analysts, no Bloomberg terminals, no fancy research subscriptions. His overhead was astonishingly low. He was a one-man Scrappy operator in the field of asset allocation. But the most important part was his fee structure and his communication. He charged his partners zero management fees. He only got paid if he made the money. His compensation was 25% of the profits above a 6% annual hurdle rate. This structure perfectly aligned his interests with his partners. He only won if they won first. Contrast this with a typical mutual fund today, which charges a flat management fee regardless of performance. Buffett's partnership was a lean, performance-oriented machine. His letters to his partners were models of clarity and transparency. He didn't use jargon or try to sound impressive. He explained his investment philosophy and his results in simple, common-sense terms. He treated his partners like what they were: partners in a business. He was applying the same principles of lean operations and clear communication to his own investment practice that he looked for in the companies he bought. He was building his own wealth and the wealth of his partners, not by constructing an impressive-looking financial empire, but by focusing relentlessly on the only thing that mattered: the final, after-fee, long-term result. The psychological principle that a lean portfolio philosophy helps you to master is the action bias. The action bias is our innate tendency to feel that we should do something, even when doing nothing is the best course of action. In investing, this bias is constantly stoked by the financial media and the brokerage industry. We are bombarded with breaking news, analyst upgrades and downgrades, and hot stock tips. This creates a feeling that we must be constantly tinkering with our portfolio, buying, selling, rebalancing, chasing the latest trend. This constant activity, however, is toxic to long-term returns. Every trade incurs costs, both in commissions and in the bid-ask spread. Every sale can trigger a taxable capital gains event. More often than not, this frantic activity leads to buying high out of excitement and selling low out of fear. The Scrappy investor's philosophy is the perfect antidote to the action bias. It embraces strategic patience. It understands that once you have identified and purchased a portfolio of wonderfully efficient businesses at fair prices, the best thing to do is often nothing. You let these compounding machines do their work over years and decades. A lean portfolio is not an active portfolio. It is a thoughtfully constructed and patiently held one. This approach runs directly counter to our brain's desire for action and stimulation, but it is the proven path to superior long-term results. It requires a shift in mindset, from seeing investing as an exciting game of constant moves to seeing it as the slow, deliberate, and sometimes boring process of owning great businesses. To put this philosophy into practice, we need a final applied mental model, the Scrappy Investor's Portfolio Construction Blueprint. This is your personal guide to building a lean, efficient, and effective portfolio. Step 1 is fanatical cost minimization. Just as Geico's key advantage was eliminating agent commissions, your key advantage is eliminating high investment fees. For the core of most people's portfolios, this means prioritizing ultra-low-cost index funds, or ETFs that track the broad market. The fees on these products can be as low as 0.03% per year, meaning almost all of your return stays in your pocket. High-fee, actively managed mutual funds are the financial equivalent of a bloated corporate headquarters, a massive drag on your long-term performance. Step 2 is decentralized decision-making, specifically for those who choose to pick individual stocks. If you venture into stock picking, use the mental models from our previous pillars. You are the Warren Buffett of your own personal Berkshire Hathaway. Your portfolio should consist of a collection of decentralized, high-performing, efficient companies. You are buying into their management teams and their operational excellence. Resist the urge to micromanage your holdings based on daily news. Trust the local genius of the great businesses you own. Step 3 is to avoid portfolio edifice. Do not be seduced by complexity. The financial industry loves to sell complex, exotic products like structured notes, hedge funds, or private equity funds to individual investors. These products are often opaque, illiquid, and come with layers of hidden fees. They are designed to look impressive and sophisticated, the financial equivalent of an architectural monument, but a simple portfolio of low-cost index funds and a handful of high-quality, easy-to-understand businesses will almost always outperform these complex monstrosities over the long run. A simple, robust, low-turnover portfolio is your Kiewit Plaza. It's functional, not flashy. Finally, step 4 is to measure what matters in your own results. Stop focusing on the short-term noise. Don't check your portfolio's value every day. Instead, focus on your long-term, after-fee, after-tax return. Are you sticking to your savings plan? Are your investment costs as low as they can be? Are you avoiding behavioral mistakes like panic selling? This is the path to achieving your own financial freedom. It's about focusing on the few key variables that you can control and ignoring the thousands that you can't. The antithesis of this lean approach is the system that defines the 99% of the financial world, the high-fee wealth management machine. This is the traditional model sold by large brokerage houses and financial advisory firms. It often begins with a financial plan that is used to justify selling you a portfolio of expensive, in-house mutual funds. These funds typically come with annual management fees of 1% to 2%, plus other hidden costs. The advisor may also encourage frequent trading, which generates commissions for them and their firm. They may recommend complex products that you don't fully understand, but that carry very high margins for the seller. This is the corporate bloat model, applied directly to your personal finances. The firm builds a beautiful office, hires a large staff, and runs expensive advertising campaigns, and all of this overhead is paid for by the high fees charged to you, the client. The firm's profitability is often prioritized over your own investment returns. This system preys on the action bias and the desire for sophistication, convincing investors that they need a complex, expensive solution when a simple, low-cost one would serve them far better. Resisting this machine and embracing the Scrappy investor's blueprint is the most important executive decision-making you will ever do for your own financial future. The direct financial connection between a lean portfolio and your ultimate wealth is the most powerful and personal financial connection of all. It is the inescapable, brutal mathematics of compounding fees. Let's run the numbers one last time. Imagine you invest $100,000 for your retirement. You have two choices. Option A is the Scrappy investor's approach, a low-cost index fund with an annual expense ratio of 0.1%. Option B is the traditional wealth management machine approach, an actively managed mutual fund with a seemingly reasonable 1.5% annual expense ratio. Both portfolios earn an average of 8% per year before fees over 30 years. After 30 years, the portfolio in Option A, the lean portfolio, will have grown to approximately $950,000. The portfolio in Option B, the high-fee portfolio, will have grown to only about $630,000. That is a difference of over $300,000. It's more than 3 times your initial investment. Where did that money go? It didn't just vanish. It was transferred, year after year, from your pocket to the pocket of the fund management company. It was used to pay for their marble lobbies, their army of salespeople, and their executive bonuses. This is the tyranny of compounding fees. Just as corporate bloat silently eats away at a company's profit margins, portfolio bloat silently eats away at your retirement nest egg. Choosing a lean, low-cost investment strategy is the single most impactful decision you can make in your journey toward long-term financial success. It is the ultimate application of the core thesis. Efficiency, whether in a corporation or in your own portfolio, is the undisputed and undefeated champion of wealth creation. You have just spent this time fundamentally rewiring the way you look at the world of business and investing. You have acquired a powerful mental tool, a kind of financial X-ray vision. You no longer see a towering headquarters and feel impressed. You see a potential liability and ask about the SG&A. You no longer hear about a charismatic CEO and get excited. You ask to see the return on invested capital. You have moved beyond the surface-level narrative and have learned to analyze the deep underlying structure of operational efficiency that truly drives long-term value. This is a profound advantage that will serve you for the rest of your investing life. But it is crucial to understand that this is only one part of a much larger, interconnected system of thought. The ability to identify a lean, scrappy, efficient operation is a foundational skill, but it is one node in a network of mental models. A company can be efficient but operate in a terrible industry with no competitive moat. A company can have high profit margins today that are destined to be competed away tomorrow. Spotting the signs of operational excellence is the first step, but a complete analysis requires you to connect that piece to the next. You must also be able to analyze the strength and durability of a company's competitive advantage, understand the quality and integrity of its management, and assess its strategy for allocating the capital it generates so efficiently. The video that is now appearing on your screen is not just another video, it is the next piece of the map. It is the link that connects what you have just mastered, the analysis of operational efficiency, to another crucial pillar in this mental arsenal. Think of it as the next layer of the blueprint. You've inspected the engine. Now it's time to inspect the fortress walls that protect it. The journey from being a passive market participant to becoming a truly sophisticated business analyst is a process of assembling these interconnected models, one by one, until you have a complete framework for making superior decisions. The choice is yours. You can stop here, with one powerful tool in your belt. Or you can continue your ascent. You can choose to complete your mental arsenal. Click on the next video and take the next step in transforming yourself into the master of your own financial destiny.